This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go!
Credit bureaus not only help you underwrite your customers, your applicants, but it's also that carrot and stick to get them to pay you back, right? So if I'm doing lending, I want to furnish not out of the goodness of my heart, so every other lender has access to that data, but because I want my customer to pay me back, and being able to hold that stick of a negative credit record over their head helps me to ensure repayment.
Hello, and welcome back to Fintech Recap. Welcome back after an extended absence. My name is Alex Johnson. You might not be familiar with my voice anymore. I am the creator of the Fintech Takes newsletter, and I am thrilled to be joined yet again. We're reunited with Jason Mikula, the publisher of Fintech Business Weekly. Jason, it's so good to see you.
It is amazing to see you. Congratulations on the new addition to your family. You've clearly missed nothing in the, I think, mere 2 months that you've been gone.
Well, it's funny.
Nothing has happened.
No, it's all been very calm and relaxed and it's just very chill summer. It's funny. I tried to unplug during paternity leave, and my employer was very, very nice in terms of just like, we want you to go away, we don't want you to touch any work stuff. But I kind of couldn't help dipping back in every once in a while to the drama on fintech Twitter. I guess now the drama's maybe porting over to Threads. Are you on Threads, Jason?
I flipped on the VPN and signed up for it this morning. I know this isn't like Platformer with Casey Newton,
Sure.
Totally different zone.
Sure.
I do feel like Threads may be the most legitimate threat to the trash fire that Elon is brewing at Twitter.
Yes, I very much agree. I was surprised at the speed at which all my favorite fintech Twitter people created Threads profiles, and it does seem like a little kind of mini community is brewing over there. So both I and Jason are over on Threads if you'd like to find us. As Jason, I think, pointed out on one of his first, what they're not tweets, are they threads if they're an individual
I
post?
guess.
Okay, we need to...
I don't know. Yeah, we need to work this out.
Yeah, we need to get some answers on that. But you posted about there will still be some Labradoodle content that's over there as well, maybe a little more even.
Well, it's interesting. Somebody pointed this out probably on Twitter. It's like, well, my Instagram people are very different than my Twitter people.
Yes.
And if you log in with your existing Instagram, if you have one, it kind of like automatically, like you just start seeing these people follow you. And I'm like, oh, like random friends from college are now just going to be exposed to this plethora of fintech content, but they can block me or whatever. Mute me.
And assuredly, all of my family members who are there for the baby pictures will just be muting my Fintech Takes immediately, which is very understandable. We have quite a few fintech things to discuss after an extended absence and a very busy last month plus of fintech stuff. So, Jason, do you want to start us off with our first story?
I will start us off, and that is Goldman's vanishing consumer ambitions. So the story, which was broken in Wall Street Journal, is that Goldman is in talks to offload its Apple partnership to American Express, which coincidentally, if you're familiar with Lower Manhattan, is literally directly across the street from Goldman's headquarters.
Oh.
So you can just walk across to negotiate that deal, I guess. As a quick refresher, Goldman has the Apple Card, which is the credit card partnership, the very recently launched Apple Savings product, and also came to an agreement to help power Apple's Buy Now, Pay Later offering, Apple Pay Later. Although I still have not seen that out in the wild, but maybe it's just because I'm not in the US. I don't know.
I actually have gotten access to it, so it is at least a little bit out in the wild. Yes, I applied for a Buy Now, Pay Later credit limit, which was kind of a weird experience, but was approved. And I guess to your point about Goldman, they power the issuing part of that, right, when the actual payment is made.
I would like to know if that shows up on your credit report, and if so, like how it's classed, but we can save that for another day.
Yes, I will report back on that.
We digress. This follows Goldman's shrinking ambitions. It ceased writing new personal loans under its Marcus brand. Full disclosure, I helped launch that product, as well as shopping its Green Sky point-of-sale lending unit, which it just acquired last year for the low price of, I think it was $2.4 billion or $2.2 billion. Yep. So, Alex, What's happening here? This feels like a very abrupt reversal from what, a lot of people were sort of touting as a successful launch of the Apple Savings feature, which feels like it was like 6 weeks ago.
Yeah.
Do we think Amex could succeed where Goldman seems not to have?
Yeah, I mean, so I think my first takeaway, Jason, is that it took a little while, but as expected, after you left, their whole consumer business just sort of collapsed. And so they rue the day that they let you go. They're obviously suffering the consequences of that. No, I mean, I I think that, as you've written about in your newsletter many times, and as we've talked about before, like this is all part and parcel of this sort of slow moving kind of disastrous pullback from their initial consumer ambitions. And I the way I wrote about it initially in my newsletter, somewhat maybe glibly, was that it reminded me a little bit of that expression that you hear in poker where it's like if you sit down at the table and you play for 30 minutes and you look around and you try to find the sucker and you can't find the sucker, get up immediately from the table because you're the sucker. And it kind of reminded me a little bit of that expression. Not that obviously Goldman hasn't had some successes in their consumer business, particularly on the lending side, but when I think about the Apple partnership in particular, and this has been true since the very beginning when they launched Apple Card in what was it, 2019? Am I getting that right? About then. And they've been really sort of into consumer as a category since like 2016, I think. When they launched it in 2019, almost immediately you started seeing evidence that like Goldman was having to take all the hits as it related to this partnership, right? There was the initial thing with the launch of the product where, Apple was like, yeah, we designed this, not a bank, blah, blah, blah. And it's like, oh, wow, we really value that Goldman Sachs partnership. And then, when there was the questions about, differential treatment for like spouses who were trying to apply for the Apple Card, like Goldman had to take the hit on that. I think it was reported recently that Goldman Sachs's losses on the Apple Card portfolio were pretty surprisingly high, like right at the high end of any of the large issuers like a Capital One or a JP Morgan Chase, even though in theory, Apple's customers should be a little higher credit quality and it's a smaller portfolio. So you'd sort of expect maybe to have kind of lower loss rates. So just taking all of those things together, my observation was that Apple clearly had really favorable terms in this partnership. And I don't know exactly what those terms were, but if you just sort of extrapolate like logically, Goldman Sachs was trying to get into this business. They were trying to make a big splash. They had all their chips and they sat down at the poker table and they started just making these really like aggressive bets. Well, there's a reason that Amex at the time or Barclays at the time or Citi or JP Morgan Chase or Capital One, like there's a reason why those companies, which have been successful in consumer lending for a long time, weren't willing to meet Apple's terms and why Goldman Sachs won. There was a reason why, they weren't willing to buy Green Sky at that price. There was a reason why they weren't willing to hang on to the General Motors portfolio, which Goldman Sachs also took on and apparently is also trying to offload maybe to Amex or someone else. Like all of these things were ones where there was a price and a set of terms where it made sense. And then there was another level that you had to go to where you could easily win the business. But as we know in consumer lending, there's always pain on the back end of those things. And particularly now that we've gone into a slightly different credit environment and we're no longer in the sort of zero rate environment, we just want to reward people for growth. I think all of those things have sort of crashed together as a realization at Goldman. And they're just like, this really isn't the business for us. So I'm not terribly surprised that this happened. And I guess my question that I didn't answer that I'll just bounce back to you is, what do you think about Amex and their potential to get into this? What's attractive to them potentially for this?
I think you're right as far as the deal terms, right? Particularly as it comes to Apple Card. And that's, I sort of always heard that Goldman won the deal because everyone else did not want it, particularly because some of the economics driven by things like no fees. And I don't just mean no annual fee, but also no late fees, which of course lowers the profitability.
Well, and even the design of like the user interface that was like, we really don't want you to pay late if you don't mean to. So it's just, it was designed to be very consumer friendly, but that comes at a cost.
Which, again, I think you and I are both very good at being able to see both sides of the argument. On the one hand, if the UX is motivating people to pay in full so they don't incur interest charges, I think that is a good consumer-friendly feature.
Totally.
On the other hand, if I were the company that is issuing those cards, like that needs to be factored into the economics of that business, right? If you have fewer people revolving and you're earning less interest income. I mean, even something, as simple as the branding, and you pointed out some of Apple's rhetoric around the launch, built by Apple, not a bank, et cetera, et cetera. I mean, even the branding of the physical card, putting, one, Goldman Sachs, not the Marcus logo, and putting it on the back.
I remember that.
And even putting the MasterCard logo on the back, which I believe, in theory, like you're not supposed to be able to do that, but like if you're big enough, you can do it if you want to.
Right.
I mean, as far as, what does this look like in a hypothetical world where Amex picks up the deal? I mean, the credit quality of the Apple portfolio is markedly lower than what Goldman was doing with their own personal loans.
Yeah.
I think something like 5% of their Marcus portfolio was below like 680, whereas something like a quarter of the Apple Card portfolio or the overall credit card portfolio was. So substantially lower credit quality. Not clear how that aligns with, Amex underwriting or Amex credit strategy. And it's just a matter of like, can you make the economics attractive? Presumably, if Goldman is looking to offload this, whoever would be acquiring it, whether it's Amex or somebody else, there needs to be a sweetener somewhere to make the numbers work.
Yeah.
I mean, I think to your point about sort of the slow unraveling of Goldman's consumer ambitions, something that always struck me when this whole project was on the way up was the sense that Goldman had a longer time horizon than a classic venture-backed startup, right? If you're VC-backed, you're operating in these sort of 12 to 18-month fundraising cycles, and you need to be able to show progress, traction, go back, raise another round. Goldman, in a sense, had sort of unlimited money to start building this stuff and had a bit of a longer leash. And I think what we've seen happen is that sort of boomerang and reverse, where it was like, okay, public markets are not liking what you're doing with Green Sky, with consumer credit, and, needing to sort of abruptly, and I would argue somewhat disjointedly.
I was going to say chaotically,
chaotically is a better word.
Yeah.
Reverse course on those efforts. I mean, even when Goldman did the reorg, the company-wide, the firm-wide reorg late last year, at the time I was like, oh yeah, they're going to get rid of Green Sky. It doesn't make any sense to have it inside this platform solutions division. And they pushed back being like, no, like Green Sky is a key part of the platform strategy.
Yeah.
Like we're going to attract these sort of mid-market businesses. And it's like, maybe. And here we are, 6 months later, and they're like, oh no, actually we're selling it.
Right.
So I mean, I think you have a business story, you have a partnership story, you have this sort of like comms and messaging story.
Well, you have a technology story too, because the other thing I've heard from Goldman multiple times that I guess is one of those things that is just a really great way to lie to yourself if you're trying to convince yourself something is a good idea or it makes sense is, well, Apple wants to partner with us because we have the best technology. Right. And like we can enable them to do things that other big banks that we might be competing with for this business can't. So, of course, our partnership and the terms of that partnership, it's favorable to us because the reason Apple picked us wasn't because of the price or the terms. It was the technology that we're offering, and we're such a great partner to work with. And I've heard that like right up until the end. Like I heard that from folks at Goldman 6 months ago going, no, like we want to be picky with the partners that we work with, but the ones we do, we have these great relationships, and, the technology is a key enabler of that. And that's going to make us sort of sticky. And we think that's like a key advantage we have in these relationships. And clearly that's not true anymore, because if you're transferring it to Amex, which I think Goldman would have laughed at 6 months ago and gone, no, their technology is not anywhere close to as good as ours. Like, turns out you don't really need a whole lot of technology to enable these partnerships. And I think the other thing, and I'd be curious for your take on this because this will relate to Amex as well, is Apple is a not great company to partner with in terms of like being a partner, right? And we talked about the branding, we talked about some of those things, but like the other part of this is Apple has this whole breakout initiative, right? And I thought it was really interesting to watch Goldman sort of navigate around all the reporting about Apple taking more of this stuff in-house, because like Apple's basically said very clearly, we want to capture more of the unit economics associated with this as we grow out our financial services business. And Goldman's like, oh no, they're a great partner. But it's like, yeah, they want you when they need you. They need you for issuing the card, but we don't want you to like fund or have anything to do with the balance sheet of these buy now, pay later loans. We need you to hold the deposits for this savings, or like we want you to, or whatever, like we'll arrange it that way. But I think every subsequent thing you were going to get through this Apple partnership, and this will probably be true with Amex as well, you can't really count on being like, oh, we're Apple's preferred partner. Because I don't think Apple has preferred partners. It kind of reminds me, to bring it all the way back to Amex, it kind of reminds me of the way that Amex lost the Costco partnership way back in the day, where it's like Costco went to that negotiation and they're like, no, you're just like our ketchup vendor and the vendor that we use for this, tennis shoe that we sell. Like, we treat all of our vendors the same, and Amex got all offended and walked away. I think Apple is going to be just another example of that, where they can do a lot of this themselves, and the partners they work with, they're going to squeeze them because that's in their best interest.
Yeah, I mean, if you're the bank issuer, considering whether or not to acquire this from Goldman, what is the benefit that Apple is supposed to bring to the table? Yeah. A huge number of users, preferably at a very low or zero CAC. Yeah. But at this point, like, there is a track record of multiple years of the Apple Card and some number of months of the savings product. So it's not like there's no data points here to evaluate. Right. And a potential acquirer is going to look and say, okay, what are the economics of this portfolio? Sure, presumably there's zero or near zero CAC, or Apple's footing some of the marketing expense or whatever. Yep. But is that enough to make the economics of the program work? In Goldman's performance to date, based on what we know, and decision to try to exit the program would seem to suggest that, at least with the current terms, it doesn't make sense. Right. You used the Costco example. That also reminded me of the Walmart Capital One example, which seems to be ending in tears with them suing each other.
And not the first time that's happened with Walmart.
Yeah. Not the first time, definitely a hardball partner. And it's like, okay, Apple is definitely, a $3 trillion company, a marquee brand to partner with. But at the end of the day, if they don't deliver value to their partners, why would you, as the bank partner, why would you want to partner with them versus spending that time, that capital on other initiatives that might be more profitable?
Absolutely. No, I agree. And I think, just to put a bow on it, the Amex point is just interesting also in that Amex has these sort of dueling aspirations of being a closed loop network and an open network. And sometimes they work with fintech partners, and sometimes they actually let other companies issue Amex cards, and they just operate as a network, but they also obviously issue their own cards. And like, there's kind of these dueling identities within Amex. They would make a fascinating partner to me for Apple, who also, I think, is wrestling with this, like, are we open? Do we work with banks? Do we work with the networks? They negotiated a sweetheart deal back in the day with Visa and MasterCard, specifically promising that they wouldn't create a closed loop payment network competitor to Visa and MasterCard. But like, I don't necessarily trust that that's going to hang on for a long time. So there's a lot of interesting, like, almost, if you think about it in cosmic terms, like galaxies that are sort of slowly colliding with each other, and they all have these sort of slightly different dynamics to them. So I'll be very curious to see, both in the short term, how this gets offloaded from Goldman, what the terms of that might be, who the new bank partner is, but also longer term, like, how do the dynamics of Apple being involved in the financial service industry change as their underlying partnerships and just priorities maybe evolve?
We will put a pin in it there, and I'm sure we'll be back on this topic in the coming months. Do you want to take us to our second topic, Alex?
I do indeed. So the second topic is one that I had to come out of hiding in paternity leave to write about in my newsletter, because I love this topic so much. And it is the sudden surging interest in fraud data consortiums. So to give a little recap, within really the last couple of weeks, we have seen announcements from Plaid, which launched a fraud data consortium called Beacon. Another fraud data consortium called Sardine X, launched by Sardine. And then a third, which was Fraud DAO, which is the fraud data consortium that was launched last year by Unit 21. And they recently I guess, announced the fundraising that they did. And this fundraising round was actually from last year. It was a Series C, but they just recently announced it and sort of framed the announcement as, oh, we're taking that money that we raised in our Series C and we're really putting most of it into growing Fraud DAO. So you have these three fraud data consortiums, Fraud DAO, Sardine X, and Beacon. It's really interesting because all of them are basically focused on solving the same problem, which is fraud is often thought of as an industry-wide problem, not an individual company problem. So while, fintech companies may compete with each other on customer acquisition, they may compete with each other in terms of going after different segments of the market from a risk perspective or a profitability perspective, and that competition can be very fierce. There's a little bit more of a collegial attitude as it relates to fraud because you really, as an industry, don't want anyone to be tolerating fraud. And I've written before about how fintech companies have had a sort of immature attitude about fraud, and that in the sort of great era of zero interest rates, fraud was something that I think we tolerated as an industry way more than we should have. That, I think, is maturing, and I think the industry is maturing, and obviously we're not in a zero-rate environment, and people aren't just focused on growth over everything. So these fraud data consortiums are launching based on the principle that fintech companies want to get a better handle on the fraud that's happening within their customer portfolios, and much like the banks that came before them, they potentially will see the value in coming together in these consortiums to share data. And that's essentially the way that these work is they all report signal to this sort of centralized database. And that signal usually comes in the form of sharing sort of very granular information about all of the customers that we're working with. So sort of the identity data that's being presented, the behavioral data that they're capturing, the data about the device, and just trying to sort of get as many different sort of individual data points that they can string together into these sort of universal identities that will make it harder, the theory goes, for either fraudsters or just sort of customers that are committing first-party fraud to sort of hop from one fintech company to the next and be able to sort of commit fraud across the fintech ecosystem. This is sort of designed to stop that. Some of the consortiums will actually allow you to report specific types of fraud that you're running into. So is this an account takeover? Is this synthetic identity fraud? What have you? And all of this really just sort of follows on the heels, as I was saying, of banks that have been doing this for years, right? So there's all kinds of existing fraud data consortiums within the banking space. The card networks have their own version. FICO, where I used to work, has their own fraud data consortium. Early Warning Services, which is a organization that's owned by the 7 largest banks in the US, they have a fraud data consortium that they use. So this is, in a lot of ways, just sort of modernizing a very old idea, but it's all of a sudden just really, really hot. And I don't know, Jason, I haven't seen you necessarily write about it in your newsletter too much yet, but what's your sort of big takeaway from this recent surge of interest?
So I'm not smart enough on the topic to offer a well-informed point of view.
Well, I'm not either, to be clear. So just jump on in with the speculation.
Yeah, I mean, with that caveat out of the way, right? I mean, you mentioned EWS. I, coming from my, consumer credit industry background, like the immediate parallel in my brain is to the credit bureaus. Yeah. However, there are some like very, very, very important differences between the two from like a business model and a like network effects perspective, right? So, I mean, I'm sure I use this word. I imagine a lot of other people, talk about the cold start problem with these consortiums, right? Fundamentally, they are, two-sided marketplaces where, companies are furnishing data about suspected or known fraudulent accounts, and then companies are consuming that data. And the utility, the value of that increases as the number of companies furnishing that data increases, right? So, I mean, the most important thing would seem to be attracting a critical mass of large enough furnishers. So something that struck me in looking at the announcements from Sardine, from Plaid, from Unit 21 is they basically included 0 or very close to 0 banks.
Yeah.
I mean, Plaid had a credit union, Viridian, and Sardine has Chesapeake Bank, and Unit 21, at least from the original announcement last October, listed fintechs like Brex and Chime, but I didn't see any banks mentioned, right? So I think it's going to be very interesting to see, is this something that establishment banks, particularly the largest ones, are willing to play ball with? My assumption, frankly, is no, probably not. So then the question is, do you have enough coverage that these are useful, even if banks sort of don't want to play here and want to go do their own thing, or EWS, ticks the box for them. And then something you wrote about that I want to hear you expand on is sort of this like pricing model, or charging or not charging, right? I mean, I mentioned in my brain sort of this being analogous to credit bureaus. Credit bureaus not only help you underwrite your customers or applicants, but it's also that carrot and stick to get them to pay you back, right? So if I'm doing lending, I want to furnish not out of the goodness of my heart, so every other lender has access to that data, but because I want my customer to pay me back, and being able to hold that stick of a negative credit record over their head helps me to ensure repayment. It's not quite clear to me that that's exactly analogous in the fraud space. I'm curious to hear your point of view on some of the business model side, or the fee side that I know you wrote about.
Yeah, absolutely. I mean, I think the sort of core question that you're trying to answer as it relates to the creation of these consortiums is, what are you, the company that's doing this work, trying to get out of it, right? And so, because I mean, these are all venture-backed fintech infrastructure companies that are doing this. Plaid, Sardine, Unit 21. They're not just investing this out of the goodness of their heart to make the ecosystem a better place. They want to get something out of it. And when you look at something like EWS, by a point of comparison, EWS wants to make money, but they're owned by the 7 largest banks, and the banks get other benefits out of cooperating, where EWS just needs to sort of exist. It doesn't necessarily need to make money. It's more a way to sort of bootstrap that network effect for things where the banks want to share intelligence on fraud, or suddenly they want to have a competitor to, Venmo and Square Cash. And so they offer, P2P payments functionality, and suddenly they have everyone connected to it. This is a little bit different, right? So when you look at the different providers, I think one of the clues you can sort of use to parse this is, to what degree do the different companies seem to be like exercising control over the consortium? And so I sort of was thinking of this as a continuum. And on the one end, from what I can tell, you sort of have Plaid, right? And Plaid, the way they are sort of talking about Beacon is, it's a Plaid product. We have multiple, customers within our 8,000 banks and fintech companies that are part of our ecosystem that are going to participate in this. There's a fee that's being charged to join the consortium. And it's not totally clear to me if there is a fee for getting intelligence or data back out of it, but I wouldn't totally be surprised by that, right? So it's a very for-profit business venture owned and controlled almost entirely by Plaid. On the other end of the continuum, I think, is more of what Sardine and Unit 21 are doing, where when you look at the language that they use to describe their consortiums, they're open networks, they're owned equally by all of the different members. I think Sardine, when they were talking about it, said Sardine has sort of an equal say to all other members, but not like a greater say. So the governance of the consortium and the rules for how it's going to work are controlled equally by everyone, right? And in the case of Unit 21, the reason they call it Fraud DAO is they actually have a decentralized autonomous organization, which is a crypto term, that they're using as the bones or the structure for creating that very open, membership-controlled organization. Now, I personally have never been able to figure out why a DAO is necessary in order to do that. And I've asked that question multiple times and haven't gotten an answer that satisfied me. But clearly they're trying to live on that side of the continuum as well. And I think what that indicates is that the companies have different goals for how they're going to sort of realize value out of them, right? So I know in the case of Unit 21, they have said, this is a contribute to get model. So again, similar to the credit bureaus, you have to furnish data in order to get data back out. But my understanding is they don't charge to join the consortium. They don't charge to get data out of the consortium. Sardine, it's a little less clear to me. I haven't gotten a clear answer from the public information I've looked at as to how they're charging for it. Plaid, again, I think is going to be a little more, we want to make money on this. But, if you look at Unit 21 and Sardine, there are other benefits that they can get out of it, right? Because they offer fraud investigation tools. They offer analytic models that are built on top of their fraud tools that can help sort of detect potential attacks. And you can imagine that this consortium data can be used to train those models and make them that much better. And so that's the other thing that you see in the banking space a lot is banks want to cooperate on fraud, but there also is some reluctance to share too much data because they know that they're helping other companies or their competitors train models that they might view as sort of a competitive advantage to themselves. So I would think that the Unit 21s and the Sardines of the world, they seem to be a little bit more on the side of, we want this network to be as sort of open as possible. And the benefit of that is more people want to participate, right? Like I could see, and you could see this even in the announcement, Sardine, while they didn't have a lot of direct banks listed, they had Alloy Labs, which is an organization made up of a lot of banks. They had Visa participating, which obviously has a lot of banks and merchants and others who are part of their network. We'll see what that actually ultimately ends up looking like. But I think the more open you are, the more members you can pull in. And then the way that you monetize it is a little less direct. Maybe it's getting them to use your other tools. Maybe it's training your fraud models, but it's probably less likely that they're going to be trying to kind of directly monetize it.
Well, and it would seem to me that Plaid has a much larger footprint to try to leverage into using this offering, right?
Yes.
I mean, what fintech or bank doesn't have a Plaid integration? I mean, pretty much all of them do, right?
Right.
So in a sense, like they have a much stronger starting point to try to leverage their existing client base into this fraud data offer.
Which is maybe why they're not necessarily as worried about, like how do we recruit people? Mm-hmm.
Exactly. Yeah. Whereas if you're Sardine or Unit 21, and I don't know an exact count of clients, but I have to imagine their footprint is significantly smaller than Plaid's footprint. It's like, okay, maybe I need to have lower barriers of entry so that I can get that flywheel going and get to a critical mass of members of the consortium and meaningful, useful amount of data that exists there. So, I mean, different starting point, different strategies of how they're going about doing it.
Yeah, no, I totally agree. And it kind of goes back to what you were saying about banks being included or not. And it's interesting, right? Because I think one of the critical downfalls of EWS, as an example, is because they're owned by the 7 largest banks, they actually have in their terms for joining their consortium, you have to be a bank in order to join. And so they do not allow fintech companies to join. And even if you're like a bank that does banking as a service, you can only share data associated with your direct customers and accounts. There is not even a mechanism if I'm, Blue Ridge or whomever to share more detailed information about what's going on at the fintech level of my network, as opposed to just my overall sort of set of accounts and customers. So, EWS and a lot of the traditional consortiums, because probably for competitive reasons, they cut fintech off from this market. And, when I look at the companies that are sort of trying to now build these new consortiums, to me, the ones that are like, we want this to be a consortium for the entire industry, those are going to be the ones that stand the best chance. Now, recruiting banks, particularly the larger banks, is not going to be something that you can do overnight. I even think that the 7 largest ones that own EWS might be sort of naturally inclined to not participate because it is competitive with EWS. But like if I'm a Sardine or a Unit 21 or a Plaid, as a starting place, I want to go get every one of the banking as a service banks immediately, right? Because not only are they banks that have their own customers and have whatever, but if you get those, sort of by default, you're kind of pulling in all of the fintechs that they work with. And so I would be trying to go after all of those. I would be trying to pick off some of the sort of regional and super regional ones that are a little bit more fintech friendly. But, I remember reading in some of the early information that Unit 21 put out about Fraud DAO, they were very much positioning this as like, the banks have EWS and we have this. And it was a very sort of us versus them thing. And it kind of cuts against that core problem, which is fraud is everyone's concern. And, it kind of, to use like a somewhat silly analogy, like if you were, living in a neighborhood and you said, well, yeah, I know that like people are breaking into people's houses, but that's like down there. That's not my problem. It's not happening in my neighborhood. Like, no, it's everybody's problem. It is the entire city of San Francisco's problem to solve. And acting like that's not true just makes the overall problem for everyone worse. And so I think that an openness and a desire to work with everybody is really important, and a focus on, as you say, overcoming those network effects and providing just as much value to the participants as quickly as possible. Like, that's how you get that flywheel spinning.
You got to be careful with the poking the SF politics bear. They're going to come at us on threads. Should we get on to our last topic for today? Maybe we each pick one of these companies that have been in the fintech M&A space in recent weeks, recent months?
Yes, you go first.
Okay, so while Alex was on paternity leave, it feels like the fintech M&A life cycle has sped up considerably. Yeah. We've seen Fifth Third acquire banking-as-a-service platform Rise, BMTX acquire Envel, which was kind of a tiny neobank, Finder acquire Finch. I will briefly opine on FIS acquiring banking-as-a-service platform Bond.
News broken by Fintech Business Weekly, I will say.
Yes, it was. So, I mean, my opinion on the standalone banking-as-a-service platform space has evolved considerably over time, right? I mean, I think a couple of different things play into that. One is the rise of what I'll call native BaaS banks. And the example I usually point to is Column. Yep. Cross River was kind of an early player, more focused on lending, where the business model was really driven from day one on focusing on partnerships enabled via technology. So the challenge that these platforms solve, your Bond, Synctera, Synapse, etc., it feels like a certain amount of the criticality of that is eroding as some banks are choosing to specialize in doing this partner banking model. I mean, you also have newer ones like Lead or Lead Bank. I never know how to say that. So there's a handful that are really approaching this in a technology-first way now that sort of obviates the need for the middleware platform. The second piece is, the business model of these platforms facilitates quicker speed to market, lower cost to market. The challenge is, okay, if you have 100 startups built on your platform, 95 of them are going to fail. The 5 that succeed presumably eventually get to a scale where they want to have a direct relationship with their partner bank for a variety of reasons, but probably most importantly, the economics. So if you're this middleware platform, the question I have is is the model just continuously refill this funnel of customers because you're leaking them all out, either because they fail or maybe they eventually succeed too much and they churn. So it's not surprising to me that we're seeing some consolidation in that space as the technology provider, banking service conglomerate acquired Bond. This feels like a logical enough home. I mean, the other deal that I mentioned, Fifth Third and Rise, it seems like an alternate exit path, right? If you're a bank that wants to play in this embedded or partner banking space, but you don't have the team or you don't have the tech, that also seems like a logical fit. I've become a little bit more skeptical about the long-term viability of banking as a service as a standalone middleware platform outside of some other technology offering bank charter distribution channel.
I totally agree. I mean, the old joke in bank technology vendor land is that FIS is where good technology goes to die. And I don't mean that to be super mean, because I know that there are really great people working at FIS, and I'm very happy for the Bond team at a reasonably good exit. But it does sort of seem like over time, there are all of these kind of cute individual ideas that end up getting sucked into these sort of megalith business models where there's a lot of cross-subsidization. FIS makes a ton of money doing certain things, and then they bring in new technology to sort of put a shine on some of the other areas that they want to get into, or even just to sort of tell their investors a cool story the next time that they meet with them. So I do think that you're going to see a lot of that consolidation. I think banks like Fifth Third getting into this space are really interesting. And the core point you made is a really good one, right? This middleware space, you're just getting squeezed on both sides. And I think that particularly the funnel refilling itself, to extend the analogy to absurd lengths, the tap at the top that's turned on, that's a zero
the VC money
rate
tap
environment. Yeah, that's the Fed keeping rates really low. And as soon as they change that, everything kind of changes. I do think there is a theory that some of the players in the banking as a service middleware space are less subject to that because the companies they're bringing in are the embedded finance non-fintech brands that are maybe offering financial services as an add-on rather than something that's going to be like a core part of their business. So maybe there's a little less negotiating pressure. But even like embedded finance, I probably should write a post on my newsletter about like, what is embedded finance a ZERP concept as well? Because you do, I think, have a longer sort of cycle of playing that out, but not everything is going to be embedded finance, right? I mean, like not every company is going to be a fintech company, sorry. And I think that that's going to be a thing that slows that space down as well. So I'm with you. I've always thought that the banking as a service middleware space is 1 to 3 companies, maybe total, that kind of end up lasting, and we're going to continue to see some wash out. Can I give you mine?
Yeah.
Okay, so really quick, mine is Robinhood acquiring the credit card startup, the most intelligent credit card ever built, X1. And that was an acquisition that was made, I believe the price that Robinhood paid was about $95 million, something like that. The amount of money that X1 had raised over the course of its life was about $60 million. So I saw a certain strain of thinking going around that was saying that Robinhood got a great deal because that's, very, very little sort of premium they're paying on top of the money that X1 raised. That seems like an obviously flawed way to think about the value of something that you're acquiring because, and I'm not saying X1 did this necessarily, but if you raise $60 million and just blow it on parties in Vegas, then paying $95 million for that is not a good deal, right? So like logically speaking, using the amount of money they raised in any way to determine the value of the asset, probably not a good idea. If you think about it from an overall sort of strategic perspective, I've thought about Robinhood over the last, year and a half, 2 years, really since the sort of halcyon days of 2020, as kind of flailing around looking for whatever's next. Like they get into 401k accounts, they open some sort of cash cards that are kind of debit card-like, but they don't totally get into banking. Now they want to offer a credit card. They're trying to get more into sort of passive long-term investing. So it's not really clear to me what Robinhood wants to be, and I don't know either. And I think that this is just them wanting to have like another story that they can tell and another way they can kind of go back to Wall Street and sort of justify what they're doing. The asset itself that they're acquiring, again, it's the smartest credit card ever built, so it sounds pretty good. When I look at it, I see a credit card that's built on a modern card issuing platform that can do lots of virtual cards, that can be a little bit more intelligent in some of the like routing and decision making that you can build on top of it. I don't see why other people building on top of a modern issuer like a Lithic or a High Note or a Marqeta couldn't do something very similar to that without a lot of work. They had, I think, a wait list of about 500,000 customers. And that was the last sort of like real numbers that I saw about the portfolio that you're acquiring. But again, if you're Robinhood, what do you care about acquiring a big set of customers? So I kind of came down as somewhat bearish on the acquisition, but I don't know. Jason, what was your take?
Yeah, I mean, I think at a very high level, I would agree with your bearish consensus. I mean, adding the credit card, you're operating on this same cross-sell logic that seems to be stuck in everyone's brain, no matter how unsuccessful most companies are at doing it. I'll say it's like, if you can find a way to tie the offering together that makes sense and appeals to your existing Robinhood brokerage customers, or vice versa, make the brokerage appeal to your existing X1 customers, could it make sense? Sure. And the example I would give is like Fidelity offers a credit card that I think it's like 2% cash back that automatically gets swept into your brokerage account. So for people who like that is what they're looking to optimize and they don't care about miles and points and all this other nonsense, like, okay, I use Fidelity, I get a Fidelity credit card, perfect, done. Can Robinhood make, I'm going to use my favorite business word, some sort of synergy happen here that actually like makes sense to leverage the credit card offering? Maybe. To your point, the product strategy has seemed to be very reactive, very flailing. So it's like, okay, we were making money off payment for order flow, making money off crypto. Like that sort of died down as, meme stock trading and crypto lost favor. Now they're probably doing treasuries because that's cool. I'm skeptical that they can actually leverage the acquisition in a coherent way that is additive to the existing users of both Robinhood and X1, but we could be wrong.
We could absolutely be wrong. Yeah, I mean, I have speculated that they could have just built this themselves, but, I've also worked at companies where they can't build anything and get it out on time. So maybe Robinhood's already sort of been fallen into that camp, and this was the easiest way to try out adding a credit card. So we will certainly see. I do think your point about the sort of synergies makes sense. I will say X1 does offer right now the ability to sort of transfer points that you earn into like stocks that you can buy. Like they have a partnership with Drive Wealth that enables that. So maybe that was the sort of glimmer of hope that Robinhood saw when they decided to make the acquisition. But, I guess in this environment, any off-ramp you can find that's mildly appealing is what you should do. So we'll probably see a lot more of this. Jason, I know we're wrapping up, but do you want to just give like your 30-second can't let it go? We have to do one of those.
Yes. I will give the very brief can't let it go. Readers of my newsletter will already be familiar, but Maza, a startup that recently announced its seed fundraising led by A16Z. To keep it very brief, at the time that I saw the announcement, its website was frankly one of the worst, most obvious UDAP, FDIC, false claims situations I've ever seen. To give some credit to the team and their BaaS partner unit and bank partner Blue Ridge, within I think 3 or 4 days of me reaching out and starting to ask questions, I think they were able to resolve pretty much all, if not all of those issues. I will say I was surprised given that, the team at Unit generally has been very good about executing on compliance and taking those issues very seriously and choosing the clients that they work with, staying away from crypto, stuff like that. Blue Ridge is operating under a consent order, so that this site existed and had false FDIC claims for more than a year was pretty astounding to me that went, unnoticed. Anyone who wants to read more can find it in my newsletter. Alex, what is your first can't let it go from coming back?
Well, so it's crypto, because this is just the thing. Maybe like my Twitter account will just become me ranting about this and all the more substantive stuff will move over to Threads. But mine was my least favorite company, which is OPNX, which is the bankruptcy claims crypto exchange that was created by the founders of Three Arrows Capital. They're up to something brand new and fascinating, which is they filed a defamation lawsuit against Mike Dudas, who is a sort of crypto enthusiast and venture capitalist in the space, who is also not a fan of Three Arrows Capital and probably said some mean things about them on Twitter. I don't know what those mean things were that rise to the level of defamation. That was not made clear. But the interesting bits, the most sort of crypto thing I've ever heard in my entire life was OPNX is now offering something called justice tokens, which are a new cryptocurrency token that if you buy them may entitle you as a holder to a portion of the proceeds from any successful defamation lawsuits against anyone who ever says anything mean about someone in the crypto ecosystem. So they've found a way, I guess, to monetize people's outrage about crypto into another way to sell a meme or shitcoin that they were very clear in marketing it is not a security and they should not expect any return for it. But of course, there will be someone in the crypto ecosystem that buys justice tokens for reasons that continue to make no sense to me. And I don't know, man, like the way that that corner of the ecosystem, to be generous, there are lots of other parts of the crypto ecosystem that don't act this way. And a lot of people in crypto think this is absolutely humiliating. But this corner of the crypto ecosystem's ability to continue to eat itself in more and more sort of humiliating and horrifying fashions just... I don't know, man. I can't look away from it. I tried to explain that to my wife, and she did not even have anywhere near the level of like context necessary to even come close to understanding it. And honestly, good for her. Like, she lives a normal, healthy life away from this stuff, and I probably need to start living that life as well.
I mean, litigation finance is a thing, but that's taking it to a whole new level that I really don't want to spend any brain space about.
You shouldn't. You absolutely shouldn't. So with that, we'll sort of gavel us to a close. Jason, it was so awesome to get back on the train and do this, and we will be back next month doing it as well. Thanks for joining me.
Absolutely looking forward to it.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.